Hi everyone, welcome to Investing Gurukul. This is Vignesh here. So in our previous video, we spoke about how to value tech companies, and then we took real examples like Paytm and saw how we can value them and identify if the company is undervalued or overvalued, and avoid investing if the company is not good at the current price point. So we'll continue to take more examples and find out how these companies are performing. So let's take PolicyBazaar as an example now. So, so this data is again from 2020 and 2021 before the IPO of PolicyBazaar. So this video is for educational purpose. We'll do further videos with the recent numbers as well. So in terms of insurance penetration, India's penetration was just 4.2%, rather the US had a 12%. Non-life insurance, 6.5 in US, in India it is 1%. Opportunity size for PolicyBazaar was $102 billion. It would have gone up further. And in 2030, it is expected to get to $520 billion at a 17.8% annual growth. So the premiums coming via online channel was just 1%. In US, it is 13.3%. There is huge scope for growth in digital channels. So digital lending as a percentage of total disbursements, again, very low penetration in India when compared to US. So digital insurance sales in India, PolicyBazaar is a clear winner with 65.3% market share, whereas others only have 35% market share in digital insurance sales in India. So PolicyBazaar seems attractive based on all these numbers and opportunity. Let's see if it was actually a good opportunity to buy at the valuations at which they came up with an IPO. So 2016, they had a revenue of around 17 crore. So from 17, they managed to grow to 75, 160, 530, and 850, which is phenomenal growth. So the company is having a phenomenal sales growth. So in terms of operating profit, nothing is attractive here. Low operating profits in 2018, but the number is increasing. So the operating margin remains highly negative, same as the case with net profit. So this company is doing well in terms of sales growth. So let's see how this company can be valued. So if you look at the median valuation, we are starting with a valuation of 8x. And if you look at their sales growth, which is phenomenal, so additional 3x. So sales versus operating expense CAGR, the difference is again good. They spend very less, but still they are able to get more sales. So 2x additional. So is their free cash flow improving? No, their free cash flow was not improving in 2021 before the IPO, so 0. So opportunity size is very big. I'm giving additional 5x because of the kind of opportunity that is available for this company. So sales efficiency index is again very good. So 3 rupees, they are 3.26 rupees they are making for every 1 rupee spent on sales and marketing. So 3x. So retention and LTV, we do not have a number. So leadership, they are a clear leader as they continue to remain number one in the digital insurance space. So PolicyBazaar can command a valuation of 24x based on the numbers that we have seen. This was just before the IPO. So sales CAGR 163%, whereas expense CAGR is just 107%, which is phenomenal. So now let's look at further details in terms of valuation. So the IPO, at the time of IPO, it was supposed to come at a 10x valuation, but they came in at a higher price point of around 39x. So if you look at competitors in the US, Lending Club, Elevate Credit, Oscar, Brighter, they were trading they came up with an IPO valuation of 2.5x, 1x, 13x, and 10x only. But PolicyBazaar came up with huge numbers. The good thing about it is we had seen a lot of corrections between 2021 and 2021 and 2025 where tech stocks got hammered and there were so many opportunities available to purchase these companies at a better price point. So even if you look at median valuation, current valuation across all these aspects, the valuation of fintech companies in US always lower than the valuation commanded by PolicyBazaar at the time of its IPO. So it was always an avoid during IPO unless there is too much euphoria that you can double your money on that day. So PharmEasy, so again, all these are old numbers. Now the company has been downsized. Company's valuation has come down by 90%. So in 2021, they had a sales CAGR of 165% and expense CAGR of 107. So net income as a percentage of sales, so net profit was growing. Though it is negative, it kept growing. So the Indian e-health sector was expected to become a $16 billion opportunity by the current year, basically growing from $1.2 billion to at a CAGR of 68%. But the company like PharmEasy struggled to maintain its market share, whereas Apollo managed to grow in the space and became a leader. So we'll do a separate case study on PharmEasy to see how they failed as a company and started showing poor growth. So let's look at the numbers from 2021 perspective. So PharmEasy based on all the valuation, you would give it as 17.5x valuation, but yeah, this company is out of the picture when it comes to IPO. They may get acquired by someone. So let's look at the next company in this space, which is Nykaa, which is a very, very interesting company. So online beauty and personal care industry kept growing in India from 14 billion rupees in 2016 to 91 in 2020. Same is the case here. Overall BPC market size in US. In US, if you look at it, the penetration is 630 and 20%. So in India, the penetration is just 6%. In the US, it is around 20%. In China, it is around 35%. So there is huge scope for a company like Nykaa to grow very fast. So it is a niche player. It is not a generic company, a niche player which has a significant advantage. It has a strong brand recall with repeat customers. So there is an increase in spend from tier 2 cities in India. So there is a rise in spend on specialized beauty and personal care categories. So there is an emergence of a sizable prestigious BPC segment. So there is a rise in popularity of online content-led discovery. There is a rise in people trying to spend more. Everyone in India is becoming aspirational. Men's segment in the beauty and personal care space is growing. So the online penetration was very low in 2021 at just 8%. So have a lot of pain points in offline fashion retails. So some stocks may not be available. It will be out of stock. Some brands are sold only via exclusive offline brand outlets. So we may not be able to go and purchase everything everywhere. So there is a lot of innovation. This is where online stores play a critical role in solving this pain point. So when it comes to Nykaa, before the IPO, it had a sales CAGR of 48.23% and expense CAGR of 43.89%, which is not great, but it is still reasonably good. So if you look at the operating cash flow, it has increased and it became positive in 2021, which is a very, very healthy sign. So as mentioned earlier, the penetration rate is very low in terms of beauty and personal care, in terms of fashion penetration, in terms of Indian demographic, in terms of opportunity size, in terms of sales growth, in terms of free cash flow positivity. So for each one of this point, I'm adding 2x additional valuation premium. So overall, if you look at it, Nykaa can be valued at 22.83 based on these numbers. So 4, 5, 8, 10, 12 plus 10x median valuation comes to 22.83. If you look at competitors in the US, again, they're all valued at a lower price point. So the median valuation, current valuation, so Etsy is one of the popular brands which can be compared with Nykaa. So even at the maximum, it was valued at 16x. So Nykaa looks a good opportunity for the long term. We'll do one more video based on the current numbers of Nykaa. So let's look at Ixigo, the next company which is similar to MakeMate. So online penetration of airline tickets, bus tickets, railways tickets, they were still not very high. Now in 2025, it has come to 65%, 30%, 90%, 30%. The growth is also phenomenal. So online travel is growing at 11% CAGR. So overall, if you look at the penetration, overall, if you look at the growth, it is very, very healthy. So Ixigo had a revenue of 42 crore in 2019. It is growing really well. So it has become a bit positive, and even it is profitable, which is a very, very good sign. So cash flows are improving. So in all these parameters, the company seems to be doing reasonably well. Now let's look at the valuation. So I would value this company at around 11.5x. If you look at it, I would value it at 11.5x based on all the numbers above. Competitors like Booking.com, Sabre in the US, when they came up with an IPO, they were at 8.5x. So even in terms of maximum valuation, Booking.com has not been valued beyond 17 times its sales. It is a clear leader. It recently entered the Indian market as well and is doing well. So this is exactly how you should value tech companies. We saw some real examples in terms of Ixigo, PharmEasy, PolicyBazaar, etc. So now, how do you invest in these companies? How can you play this team? So the best way to play this team is to diversify and participate. If you can invest across multiple stocks in this space, you can actually do really well. So if you look at the US tech mutual funds, they have given the best returns in the last 10 years. So all the SaaS companies, tech companies, they have been doing exceptionally well. So generational wealth has been created in tech companies in the US and in China. So are we expecting something similar in India? Yes, maybe. But you have to buy them at the right valuation when it is very, very attractive. So that is why it is important to have some exposure towards these tech stocks, but not in specific select individual stocks. Instead, you can buy them as a basket. So this theme will play out, but it is a high risk, high reward bet because of the valuations it commands. So the problem is not with the business model or with the company growing its sales. The problem always lies in the valuation. So you will not be able to get it at an attractive price point unless there is a significant correction. So whenever it remains at high valuation, don't buy. Whenever there is a correction, whenever there is a steep correction after results, you can start buying them together as like a mutual fund. So buy these stocks together and play this theme. So consider investing in these companies like a mutual fund so that you can have a share of success of this sunrise sector in India. They will do well. So you can also generate significant wealth by investing in these companies. So always be wary of the valuations. So consider doing an SIP of these companies like Zomato, Nykaa, PolicyBazaar, Delivery. Do an SIP. So every month, start purchasing these companies over a period of 2 to 3 years, and then you can leave it for long term. So it is something you can do to play a part in this particular theme. So this will actually diversify your risk, and it will also help you to participate in this theme, which is very important. So yeah, this video sums up our tech investing series. So we saw videos about how tech companies in US are valued, why these companies remain loss making, how to value them. So how to value Indian tech companies, what kind of valuations to give. So how can we participate? So we have seen all these things. So in the next video in the series, we would like to take a specific company like a Zomato or a Nykaa or a Paytm or a PolicyBazaar. We'll review it based on the latest quarter performance and the last 3 years of performance. So if you want us to invest time and if you want us to review a specific stock which is in your mind, post it in our comment section. Make sure post it in our comment section and tell us which stock you want us to analyze. We'll take that stock and do an analysis and tell you if it is valued reasonably now or if it is overvalued. If you want to continue getting good inputs about tech investing and about dividend investing and about building good wealth, keep subscribing to our channel. Thank you.